Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host at AlgoBot, and today we're studying a strategy called the Trend Hedge Recovery Overlay. This one blends a classic trend-following entry, built on two moving averages, with a protective hedging layer that responds when a trade moves against it. By the end of this video, you'll understand how the strategy reads the trend, when it adds a balancing position, and how it manages the whole basket. Remember, this is educational information only and not financial advice. Let's dive in. The Trend Hedge Recovery Overlay is an expert advisor that combines two familiar ideas into a single automated system. At its core sits a trend-following engine driven by two exponential moving averages, a fast one and a slow one. When the fast average crosses above the slow average, the strategy reads that as an emerging uptrend and considers a long position. When the fast average crosses below the slow one, it reads a developing downtrend and considers a short. That is the trend layer, and on its own, it is a very traditional moving average crossover approach. What makes this strategy distinct is the hedge overlay wrapped around that entry. If the primary trade moves against the position by a defined distance, measured in multiples of the average true range, the strategy opens an opposing position of equal size on the other side. Because a long and a short are now held at the same time, the floating loss is effectively frozen while the strategy works to bring the combined basket back toward a net positive result. This is why the expert advisor requires a MetaTrader 5 hedging account, where a long and a short can coexist rather than canceling each other out. Every individual leg still carries its own stop loss and take profit, both derived from the average true range, so risk is defined on each order. On top of that, the entire basket is monitored as one unit, and it closes together when its floating profit reaches a set money target or when its floating loss reaches a hard risk cap. This kind of design tends to interest traders who are curious about hedging mechanics and basket management, and who want to study how a directional signal and a defensive overlay interact. As always, hedging does not remove risk, and losses do occur. Everything here is for educational purposes only. Let's walk through the mechanics step by step. On every newly closed bar, the strategy recalculates three values. First, the fast exponential moving average, defaulting to a period of 12. Second, the slow exponential moving average, defaulting to 34. And third, the average true range over 14 bars, which measures how much the market is moving. The first job is to open a primary position, and this only happens when the account is flat, meaning no positions from this strategy are currently open. If the fast average has just crossed from at or below the slow average to above it, the strategy signals a fresh upward cross and opens a primary long at the current ask price. If instead the fast average has just crossed from at or above the slow average to below it, that is a fresh downward cross, and the strategy opens a primary short at the current bid. Each of these entries comes with two protective levels, both scaled by the average true range. For a long, the stop loss sits 4 times the ATR below the entry by default, and the take profit sits 2.5 times the ATR above it. For a short, those distances flip, so the stop sits above the entry and the target sits below. Because these levels are based on the average true range, they automatically widen in volatile conditions and tighten in calm ones. Now the hedge layer. Once a single primary position is open, the strategy measures how far price has moved against it. If that adverse move reaches the hedge trigger multiple, 1.5 times the ATR by default, and no hedge yet exists, the strategy opens an opposing position of equal size. A struggling long is balanced by a new short, and a struggling short is balanced by a new long. With both sides open, further movement in either direction is largely offset. Finally, the basket is managed as a whole. On every tick, the strategy sums the floating profit and swap of all its positions. If that total reaches the basket take profit money target, $30 by default, every position closes together, banking the recovery. If the total instead falls to the basket loss cap, for $100 by default, everything closes to cap the risk. That combination of per leg stops and a basket-wide exit is the heart of this design. Let's look at the code as it appears in MetaTrader. At the top are the input parameters you can adjust in the strategy settings. FastEma and SlowEma set the two moving average periods, 12, and 34 by default. ATR period controls the average true range length. HedgeTriggerAtr decides how far the primary must move against you in ATR multiples before the hedge is added. ATR stop multiple and ATR TP multiple scale the stop loss and take profit, while BasketTpMoney and BasketSlMoney set the profit target and risk cap for the whole basket. Lots is the volume for each leg. Below the inputs, two Boolean values describe the crossover. Cross-up is true when the previous fast value was at or below the slow value, and the current fast value is now above it. Cross-down is the mirror image. When the account is flat and cross-up is true, the code takes the ask price and calls send with an order type of buy, placing the stop 4 times ATR below entry and the target 2.5 times ATR above. When cross-down is true instead, it takes the bid and calls send with an order type of sell, with the stop above entry and the target below. Inside the send helper, a simple check routes the order. If the type is buy, it calls trade.buy with the lot size, symbol, stop and target. Otherwise, it calls trade.sell with the same structure. Notice that both the long and short paths are fully defined, so the strategy trades in either direction with symmetric risk placement. It's clean, readable, and it mirrors the logic we just described. Now let's bring the logic to life on this illustrative chart. On the price candles, you can see 2 lines. A faster moving average, in gold, that reacts quickly to price, and a slower moving average, in blue, that lags behind and smooths things out. Watch how they weave together, because their crossings are the entire signal. We begin on the left, where price is drifting lower. Over the first 3 candles, the market slips down, and the fast average sits below the slow average. That tells the strategy the recent momentum is soft, so it stays flat and simply waits. There is no position on the account yet. Then something shifts. On the 4th candle, price snaps back upward with a strong close, and the fast average curls up and crosses above the slow average. This is the fresh upward crossover the strategy is looking for. Because the account is flat and the cross has just occurred, the buy entry marker appears, and a primary long position opens at the ask. At the same moment, the strategy places a stop loss below the entry and a take profit above it, both measured as multiples of the average true range, so the protective distances match current volatility. From there, momentum builds. The next several candles print higher highs and higher lows, and the fast average pulls further above the slow one, confirming the trend the entry was based on. Price climbs steadily toward the take profit target you see marked above. As that candle tags the take profit level, the long position closes and the trade is complete. Notice the risk structure built into this. The target sits 2.5 ATR from entry, while the stop sits 4 ATR away. So the trade's risk profile is defined in advance rather than left to a guess. Now the chart transitions into the second scenario, the short side. After the peak, price stalls and begins to roll over. The candles lose their upward push, upper wicks appear, and the fast average flattens and then hooks downward. On the candle where the fast average crosses back below the slow average, we get the mirror image of our first signal, a fresh downward crossover. The sell entry marker appears, and because the account is flat again, a primary short opens at the bid. Just as before, protective levels are placed immediately. For this short, the stop loss sits above the entry and the take profit sits below it, again scaled by the average true range. The strategy is treating both directions symmetrically, which is one of the things that makes this design straightforward to reason about. Price then works its way lower. Each following candle closes beneath the last. The fast average leads the slow average downward, and the move carries toward the take profit target marked below. When price reaches that level, the short closes for a completed trade. Now, I've walked this through as 2 clean, one-sided trades, so the crossover logic is easy to follow, but it's worth remembering the hedge overlay we discussed earlier. In a less cooperative market, price might move against the primary right after entry. If that adverse move reached 1.5 times the ATR before the target was reached, the strategy would have added an opposing leg of equal size, holding a long and a short together to freeze the drawdown while it worked the basket back toward its money target. That defensive behavior doesn't show on this tidy illustration, but it is always running in the background. So the visual takeaway is simple. The 2 moving averages define the trend. Their crossover opens the trade in that direction, The average true range sets the protective distances, and the basket logic manages the outcome. It's a compact way to combine a directional signal with a defensive framework. And of course, no illustration like this can promise how any real market will behave, so treat it strictly as a learning tool. And that brings us to the end of our breakdown of the Trend Hedge Recovery Overlay. We covered how the strategy uses a fast and slow exponential moving average crossover to enter with the trend, how each leg carries an ATR-based stop loss and take profit, how the hedge overlay adds an opposing position when a trade moves against it, and how the basket is closed as a whole at a profit target or a risk cap. Hopefully that gives you a clearer picture of how a trend entry and a defensive hedge can work together in one automated system. Remember, everything in this video is educational information only and not financial advice. Trading carries real risk, and losses are a normal part of it. If you found this helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy breakdowns. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.